Hello and welcome to the Reorg. This is your host, Michael Goldstein, also known as Bitstein. Today I have with me again my friend and colleague, Pierre Rochard. Pierre, how are you?
Very well. How are you, Michael?
Good. So in the Reorg, we're revisiting, doing a deep dive into the S&I archives and, trying to add some commentary to see how things have held up and what we can learn from, even ideas that are over a decade old. And our first sort of series, we're going through the S&I crash course. And you were actually the author of a number of these, especially these first ones we're talking about. And we're starting with basically stuff focused on monetary policy. So, as we said in the crash course, in terms of monetary policy, Bitcoin is the greatest money the world has ever seen. And last time we talked about End the Fed Hoard Bitcoins, which was the very first article that we had released, looking at Bitcoin as a way to replace the monetary system, not because of a political will, but because it's literally just better money. And today, I want to talk about the next article, which is called Fractional Reserve Banking is Obsolete. And this article, I believe, was the second article that we put out. So this is also very, very early in our exploration of these ideas. And it's a provocative title, especially since, fractional reserve banking has been one of the big bugaboos of Bitcoin from day one. You can see problems that, Satoshi addresses around, the trust in financial intermediaries and how money can get debased, and this being a major motivating factor for creating Bitcoin. So you wrote this in February of 2013. So this was soon after the previous article we read. And this one's a very short one, so I thought I would just read through the whole thing, and then we could, kind of discuss a lot of the ideas that there is. Despite being a very short article, there's a lot that can be unpacked from it. So I look forward to getting into that discussion. So, in the definitive treatise on Austrian business cycle theory, money, bank credit, and economic cycles, Jesus Huerta de Soto establishes the inevitability of economic crises wherever there is fractional reserve banking. All that is left for monetary scholars to do is analyze past crises and lobby the government to have the right reforms. Fortunately, for the first time in history, we are in the enviable position of not having to wait for reforms that may or may not lead to sound money. I explain why here. My favorite part about the Bitcoin network is not that it makes society freer, more prosperous, or more just. My favorite part is that it will finally settle one of the longest debates in the history of economics, whether or not money printing and cheap credit are ever needed to stimulate growth. Austrians know that artificial credit expansion inevitably causes a mispricing and misallocation of capital, whether it's due to fractional reserve banking alone or in conjunction with a central bank. What is debated is the ethical legitimacy of fractional reserve banking. One side sees lending out deposits as inherently fraudulent, while the other sees deposits as an especially liquid loan. With a deposit, you are improving the custody and safekeeping of your money and receiving other peripheral services, cashier and bookkeeping services, while at all times retaining the full availability of your money. You are relying on this service to lower the transaction costs of using your gold, silver, or government scrip. A superior service is built into Bitcoin. Mathematically, there is no better custodian or safekeeper for your money than an encrypted digital wallet. If you use strong passwords, back up your data, and secure your computer, then your Bitcoins are safer than your person. Bitcoin is the ideal cashier. It is available anywhere in the world with an internet connection. It can make infinite amounts of change, and it can transfer money to any account almost instantly. The distributed, unalterable blockchain puts banks' bookkeeping and check clearing systems to shame. With this level of perfect security and complete convenience, there is no reason to deposit your money with a third party. In other words, Bitcoin makes fractional reserve banking an obsolete technology, and Bitcoin wallets are the best 100% reserve banks conceivable. As Bitcoin adoption increases, we will finally be able to quote, empirically validate what Austrians have been arguing for decades. 100% reserve banking with a scarce medium of exchange prevents speculative manias, financial crises, and economic depressions. And a quote from Ludwig von Mises. What is needed for a sound expansion of production is additional capital goods, not money or fiduciary media. The credit boom is built on the sands of banknotes and deposits. It must collapse. So, like I said, it's a very short article, but it packs a big punch, and there is a lot to take from it. So I thought we'd get started just talking a little bit about, money and banking in the role of the role of money and banking in Austrian economics and sort of, where it stands. I view money and banking as sort of the pinnacle of Austrian economics. It's because money itself, being what supports the division of labor and allows for rational economic planning is basically the key ingredient for any, meaningful economic society. And so understanding money and banking is sort of, in many ways, a final boss to understanding how acting individuals work together to coordinate, to give each other, what they need, and also understanding the problems of social discoordination created by messing with these structures. And so I think it's sort of a sort of a pinnacle, so to speak. Maybe there's a better word, but curious what you think there.
Yeah, I agree. When I got interested in Austrian economics, it wasn't the first topic I read about, just browsing Mises.org or Wikipedia. But when I stumbled across it, it quickly became the topic I found most interesting for the reasons you cited. When you're thinking about what are the big questions, and Austrian economics has a lot to say about a lot of different topics, right? You might get interested in topics around intellectual property or even physical property, easements. There's lots of political related topics or just pure economic theory questions. And to me, the macroeconomics, if we want to call it that, Austrians probably don't like that term, I think that's the biggest question. And it's one that has attracted lots of very intelligent people, but also lots of cranks, money cranks, who have kind of theories that are disconnected from reality or illogical or just purely pandering to the powers that be. I'm thinking of modern monetary theory there. And so when I started reading about the business cycle from an Austrian perspective, it really is jarring how they have a solid explanation for what's going on in the economy. But then if you turn on CNBC, people who are paid to understand this stuff, they have no clue what's going on. So it's just a tremendous contrast between the mainstream. And it kind of felt like, when I was reading about it, that it was secret knowledge, some kind of a hack in the system that I had discovered that I'm able to learn about something that nobody else knows about. But of course, it's not secret knowledge. It's not taught in schools because obviously the people who are funding the schools, i.e. the government, have no interest in the population understanding what's going on behind the scenes in the banking system and the interweaving, because this is very important. There's a very strong linkage between government financing and fractional reserve banking. So when banks are required to hold regulatory capital, you might think, oh, well, they should hold something that's, very secure, like corporate bonds or gold or some other commodity or some basket of different goods or different investments, some kind of diversified portfolio of investments. No, not at all. They are required to hold government debt. So it's very it's a very good way for the government to be able to place their debt and have an unnatural buyer for it. And in return, what the banking system gets is bailouts, right? So it's kind of it's a very mutually beneficial relationship that the government will print lots of money and help the bankers when they need it, and the bankers will help the government when they need it. So that, and of course, because there's lots of court intellectuals, as Murray Rothbard might describe them, the debate has just gone on and on and on of, is this good or bad, or can it be reformed? Can it be optimized? Can it be improved? Or, what are the alternatives? And that's, what I get at in this piece is that finally we can do away with the fake debates that are financed by fiat money, and we can actually run the experiment itself, which I think should appeal to the historicists and empiricists who are often on the opposite side of the debate versus the Austrians. So yeah, that's kind of the prelude. There's lots to unpack, as you mentioned in here. This is a very high density piece. I think that there's some things that, maybe I would elaborate on and amend in hindsight since I wrote this. But I think it's a great place to start.
Yeah, well, and I think it's also important to mention that even within Austrian circles, there are multiple lineages in the world of Austrian economics. So you and I are sort of part of a lineage that goes from, Menger through Mises to Rothbard and Hoppe and Huerta de Soto and such. Whereas there's also people who were more focused on, say, Hayekian knowledge problems, or there's some who think that Mises himself was taking a wrong turn away from some Mengerian ideas. So there's not really it's kind of like in Bitcoin where from the outside it might seem like an echo chamber, but there's actually a lot of diverse opinions, and people like George Selgin, for instance, who I think is one of the big proponents of free banking. He's done a lot of work on the history and theory of free banking, what he calls free banking, which that term we can get into, but he actually comes from an Austrian background. I don't know that he calls himself that anymore, but he was actually trying to establish his free banking ideas through a Misesian lens. So even within that, there's a lot of disagreements, and this is sort of the start of this. Is at the Mises Circle we had done readings from people like Selgin, but also from Hoppe and Holzman and such, basically arguing works like Against Fiduciary Media, and then the responses to that and the responses to that, and it goes on and on and on and on. And this really was one of the exciting things. I remember when you wrote this, and it was such a relief of actually all that stuff that we got so focused on, maybe it doesn't actually matter anymore. Although I say that, and there's still a lot of debates in Bitcoin of people wanting to insist on certain business models maybe being more important than others. Of course, like that being said, because of what you're describing here, if you're just a Bitcoiner, you don't have to actually care. The only person who has to care about those ideas are the ones who are choosing to actually partake in a financial intermediary, which I would argue is actually just a total victory for what is being argued here.
Yeah, and I want to take a moment and maybe try my hand at steel manning the free banking position, which is that when you look at an economy, you're going to have seasonal and just changing demands for how much money the economy needs. And that the banking system is really in an ideal position to provide that flexibility, to provide an elastic supply of money so that the supply of money can expand when more money is needed and then contract when less money is needed. so that the price level is stable and so that people can engage in economic calculation in a way that is predictable, and you don't have the volatility, and that the banking system provides this to the economy in a free market way, and that you don't actually need a central bank. The banks will police each other and provide services for depositors that ultimately are socially beneficial from a macroeconomic perspective. I don't know, Michael, if you think that's a fair characterization.
Yes, I think so. And I think that policing is an important point from their side. And I do think that there's, some level of truth to it, which is on a free market, if you have a bank that's getting out of hand because they are trying to basically create more credit expansion than actual demand exists, which is basically their argument. I mean, free bankers are not arguing that there should just be all the credit expansion in the world. It's that it should be based on real demand at the banks. And if someone is going beyond that, that is going to put the bank at a very precarious situation, which is obviously a profit opportunity for other banks that can, take on new customers when people start to figure things out. I think, maybe if you could explain the Austrian business cycle theory and like why any of this, kind of matters, underneath the hood is like, what is the problem with, too much credit expansion and what does it do to the economy? Because that's effectively the problem that all of us were trying to solve, both sides, at least in the Austrian school. I mean, I guess actually all economists when they're thinking about this, but the Austrians differ in that we focus on the boom more so than the bust typically. But if you could explain what the business cycle theory is and why it matters here.
Yeah, absolutely. And I can kind of frame it as a rebuttal to the steel man I put up, and maybe then, George Selgin, if he's listening, will be like, hey, actually, you set up a straw man and you took it down. But I'll do my best. So I think that, the idea of neutralizing changes in demand for money by expanding and contracting the supply of money, instead of neutralizing changes in demand for money by having prices change, means that prices end up falsified. And so then entrepreneurs or, economic actors within the economy are actually getting incorrect price signals because of this falsification. And so, on one hand, it's like, oh, well, we want prices to be stable, but we also have to maintain the Hayekian insight that prices are information, and that if you decide to withhold information or to change it, then people are not going to make the correct decisions about capital allocation. So in particular, what happens is that entrepreneurs think that the economy has more resources than it actually does. And so they start on projects that assume that they're going to have the means to fulfill those projects. That is, that they're going to be able to put together producer goods, and building a producer good, inevitably it takes time, right? So you have to spend money over time, and then let's say you start on day zero and you finish 2 years later, and you're assuming a certain amount of demand, you're assuming that you're going to have the resources to finish it after 2 years. Now, the Austrian business cycle theory is essentially the idea that because the prices were falsified, you're actually not going to have sufficient real resources to complete in aggregate all of these capital expenditures, and that you're going to have a bust of incomplete projects that have to be liquidated, and that this ends up being a loss for the economy, and an unnecessary one that wouldn't have occurred if the price signals had not been hampered by fiddling with the money supply. And yeah, Michael, let me know if I left anything out there in that kind of high-level summary.
Yeah, well, I think, Mises has a sort of classic example of, illustration, I should say, of someone building a house and they think they have way more bricks than they actually do. And so they're building the house. They're very excited because it's going to be a big, beautiful house. And then at some point they get to the last brick and it turns out that they don't have what they have, I thought they had, and so they have to just, give up the whole thing. And of course, this unwinds, so people who were, lending out these funds based on not real savings, they also, there's a cascade of problems, and this is a fully systemic problem. So it's across the entire economy.
Yeah, and you mentioned not real savings, and so I think you're right. I would add some. I'd further elaborate on that and say that if you are depositing cash at a bank, and you're thinking about it as cash on your balance sheet, you're not thinking about it as I am lending money to the bank, and I understand I'm putting that money at risk, and that it might not be there when I come to get it, which is typically, why people, it's, that's, there's essentially a disagreement or a lack of alignment between what the bank thinks you're doing versus what you are actually doing. The bank thinks that you're lending them money and that they can turn around and lend that money out to finance the production of goods, as we were talking about. The problem is that you are not lending the money to the bank. You are just saving it there for safekeeping, and that you expect it to be available at a later point. And so they have inflated the amount of investment in the economy beyond what people were actually investing. And in fact, they were actually saving. And so that misalignment between what the bank thinks is happening and what you think is happening, I think is fundamentally what fractional reserve banking, that's its fundamental problem. And furthermore, this idea that you can predict actuarially, okay, well, if we have $100 million of deposits, and we know, people will deposit 10 million, withdraw 10 million, so we just need to keep a cushion of cash around to handle these deposits and withdrawals. And, so let's say we can lend out half of the deposits and we'll be okay, because it's not like everybody's going to come to the bank and withdraw it. The problem is that that's not a sound actuarial assumption, because you're promising to everyone that they can all come and withdraw it. And so that's how you end up with a bank run, is that everybody does come and withdraw it. Now, then they're like, oh, okay, well, we need to close the bank and prevent people from withdrawing their money. And so that's where you really see the misalignment come to a halt and come to the fore. That's where the rubber hits the road, is that you have a line of people outside the bank trying to get their money, and the money's not there.
And then at that point, no one can use money for any of its actual purposes. And so it's a failure of the whole system.
That's right. Now, that's where we get into political economy, which is that if you're a politician who depends on votes, and you look at this situation, you're like, okay, well, if I don't use the power of the state to remedy this problem, I'm going to lose the next election, right? And so there is tremendous political pressure, not just from the bankers to bail out the bankers, but also from the depositors to bail out the depositors. And all your voters are depositors. And so that's where I think that the free banking really falls apart, is when you introduce the political aspect of, human action, and see that, what will happen is that now the government will get into the business of providing uneconomical insurance, right? So FDIC. Something that would never be viable in the free market. It has to be subsidized by the state. And of course, having a lender of last resort, a Federal Reserve, a central bank to bail out the whole system in the case of a bank run. So that's where there's a slippery slope from free banking to central banking. And we've seen it play out over and over and over. And the idea that, well, if we just educate people, that they need to accept bank runs in order to have a free market, that's just a non-starter from a political perspective. I think that's fine from an academic perspective, but it has just not worked out in reality.
I also think it's unfortunate to make people believe as though these sort of bank run, as a, shall we say, when we make people think that bank runs are an inherent part of a free market, as opposed to actually a sort of free market response to kind of non-free market failures in many cases. Much like, people have been at this point trained to believe that the business cycle is an inherent part of the free market, and therefore that is why regulatory oversight is necessary from the government, because we cannot allow the free market to, the free market is good except for when you run into these situations. And so it really starts to creep in with the regulatory demand, and then people also have a misguided view of, well, what would the ideal be, and what would actually sort of help solve these systemic problems? And they tend towards, yet another regulation, as opposed to recognizing if we had a market that understood. Because I agree with Huerta de Soto and Rothbard and et cetera that fractional reserve banking is sort of inherently fraudulent. And so that would actually not be, allowed on a free market. It would be seen as practically a criminal activity, and so it would not be a feature of that market, and thus you wouldn't have the effects and ramifications you'd have to deal with. As far as I want to talk a little bit about Huerta de Soto's book, The Money, Bank Credit, and Economic Cycles. This is a very large tome. I think it's about 900 pages. I remember seeing you with a copy of it for the first time, and it was just a giant tome, like you're pulling something out of a medieval library or something. And he gets into, he attacks fractional reserve banking from many different angles, but I think very, very pertinent to this particular discussion, I think, with Bitcoin is his legal distinctions. And this gets into where you were saying how we think of a deposit as being a deposit. Like here are the goods we'd like you to hold on to. Please hold it in a warehouse and keep it safe for me. And I'm going to come back to get it at some point. And that's just the agreement, versus the idea of a deposit being a loan where you're actually lending out to the bank. And what Huerta de Soto does is he's primarily looking from a Roman law perspective at first, which is just kind of understanding what is the nature of these different contracts, and he kind of distinguishes the different kinds. So he talks about specifically a regular and irregular demand. Basically, demand deposits being those which you're asking for safekeeping. And then he talks about loan contracts, and he really separates these things out very, very clearly. And there's different kinds of loans. You have like a mutual, you have loans where, you want the exact good back. Like you loan someone a car, you want them to bring back the car. You don't want to give out, a Ferrari and get back a Pinto. And then there's time deposits where like a irregular deposit that you might have with money, where you don't need to give me back the exact dollar bills that I gave you. I just need the dollar bills back. And so, he separates all these things out. And I think a big takeaway from him is, very much in line with what Rothbard argued for, which is just don't mix them. That's all. Neither of these things, doing a deposit or doing a loan, neither is, unethical in and of itself. What is unethical is putting them together. And you put this exactly, where the bank has a completely different view of what is going on than the regular person who's depositing with that bank. I would guess that if we talk to just, regular people, about 99.9% of them, maybe even more, would think that when you give money to a bank, that money is just, it's sitting there in a vault, just like, in an old movie or something. It's just, it's just in a vault waiting to be, someone to come by and take their deposit out because they need to go do something. Whereas in the fine print, that's not the case. You actually are kind of like handing it over and they can do whatever they want. And the free banking types, they view it as legitimate if people are voluntarily agreeing with it. And part of the argument is that I don't think that people are actually voluntarily agreeing to these things. And actually, if you separated it out, it would do a better job of making these agreements clear, because most people by default think that they're just giving a deposit. So it's like that is an easy contract to deal with, and you just do it. But when you're taking that and doing these other things, those people don't expect it. And so that's where the fraud is sort of setting in. That sets in motion all kinds of issues. And on top of that, we live in an economic system where, especially with a central bank, when they issue dollars, those dollars, that's actually new base money. So when your regional bank is issuing a loan and basically, with whatever number of reserves, percentage of reserves, and so they're able to put new dollars on the balance sheet, that's coming basically out of thin air. And but all of those dollars are seen as fungible with all other dollars in the entire global economy. And so when people are engaging in that voluntary so-called, contract, they're effectively changing everyone's base money systematically. And that is a real difference than, someone coming to an agreement that has more of a localized effect. And specifically with the way our economy is, starting with gold, as we've described, it's very hard to do anything with gold. You're going to want to put it into a bank and have an intermediary. Whereas because of that, when you are doing this, like I said, you're actually affecting the real base money, and you kind of have to do it. You don't really even have an option. You have to engage with the system. And in fact, we've seen how obviously the convenience of credit and such has taken the world by storm. And so, I think a lot of people in fact, and for good reason, use credit cards when they're spending fiat. But we also do live in a world where it's, you're not going to store all of your cash under your mattress and actually use cash. You certainly can't do it if you want to do any kind of online commerce. You might use a debit card, but that also has its own kind of risks. And so people are basically kind of like forced into this way of doing things, and they're not fully aware of what those contracts are. And they're certainly not fully aware of the effects that this can have. And even if they were aware, it doesn't really matter, because as long as other people are doing it, you're going to face those effects. It doesn't matter if you're trying to be, good about things. Even someone who's holding Bitcoin, they still experience price changes that they otherwise would not have to experience, because of the fact that most of the businesses that they're dealing with, it's not a, quote, circular economy. It's a big economy that's mostly dollars. And so the price of food going up in dollar terms still means that you're spending more sats than you would otherwise have to, because of the inflationary effects of, new dollar creation. So I think Puerto de Soto's distinguishing, being able to distinguish these different types of contracts and just say, none of them are wrong, just make sure that they don't mix. That is really what's key here, and I think where Bitcoin really comes in and shines.
Yeah, I agree. Let's get into the article here.
Yeah, so I think the important thing there is if we imagine that we're separating two things, we're saying have a deposit or have a loan, but then he goes into the historical arguments, and you start to see how these banks can't necessarily be trusted. There are sort of these inherent risks of just, banks always having that, kind of desire to get free money where they can. My favorite example, he talks about some banks, I believe they're in Catalonia or so in like the 13th century. And they got to the point where they were actually, they were saying if you basically have a bank failure, which means that you had done fractional reserves, you are forced onto a diet of, like stale bread and water, and you have to go apologize to each and every person. It's just this sort of like draconian, medieval punishment for, having defrauded people. And it got so bad that they even had to just straight up say, if you have a bank failure, once again, it's not because there was a robber, but because you were doing fractional reserves and it fell apart, we are going to chop your head off. And it mentions that at least one banker had his head chopped off at the time because of it. And even then, in the following decades and century, there was a major credit crisis. So what I like to think there is that even with an intense, a sword of Damocles hanging over these bankers, they couldn't help themselves. And there was still the fallout of fractional reserve banking. And so there's always this sort of inherent distrust with financial intermediaries that we have to consider, specifically, especially with, this problem of mixing the two. But as you describe, Bitcoin offers everything you need for that deposit system. You can do it here with your own keys, and not mentioned here because I don't think it was as appreciated at the time, but with your own node, you can have the perfect deposit system. And if your goal is to simply hold Bitcoin, you don't need anything else. It's all there for you, and you are not reliant on that. And in fact, using a third party itself has all kinds of risks to consider, not just with the counterparty in terms of is he a good guy or a bad guy. Even the most trustworthy person can still face certain kinds of security risks that are not necessarily fixed by outsourcing it to a third party. And so Bitcoin in and of itself, as its own system, handles the deposit aspect of banking institutions, as well as the transferring between. So if you want to move that deposit to another place, you can do that. All you have to do is use the Bitcoin system. And so the only place, at least as you're describing in this article, and maybe you have some updates to this, the only reason that you'd be involved with a financial institution is because there is some kind of actual financial contract that you want to enter, so an opt-in process, and you want to you're going to need a financial intermediary, just in the sense that that's what they do, because they're trying to connect two separate actors who are trying to both get some side of a financial deal. So it's something like that. It's not deposits, and it's also not affecting base money, and so it's much more localized in terms of what risks exist for the people engaged in those contracts.
Yeah, I think there's a number of things I would amend here. So to your point about the node, at the time when I wrote this, I did not know that you could have a Bitcoin wallet without a Bitcoin node. I was running, what we call Bitcoin Core, Bitcoin QT on my laptop, and I just thought that was it. That you have you have it bundled in like that. So I would definitely add the node verification part to this. The other is that I grew up with computers around me, and I was a bit of a nerd in high school. I was installing Linux on computers and in the command line, and kind of just had some intuitions about computer security and private keys and things like that came naturally to me. And I think that a lot of people, obviously, it's very unnatural to them. And so it kind of came as a surprise to me as the years went by, and I'd hear people talk about how they just don't feel like they are comfortable self-custodying, and they just feel more comfortable using a custodian. And we can try to, persuade them otherwise all day long. But the market reality is that there's a lot of people who just prefer having a third party involved in either, in a direct way of like Coinbase holding your keys, or an indirect way like a multi-sig service provider. So that's something else I would add there. But I actually don't think that it affects the fundamental point, which is that you can't have fiduciary media mixing in with physical Bitcoin on the base layer. And so that's really where, the separation is insurmountable. And so when we look at historical cases of businesses that de facto were, let's say, quote unquote, fractional reserve, we can start with Mt. Gox, and then there's been many since then, where they don't have all the Bitcoin that they owe to customers. There's a bank run, so they have to go bankrupt, and then the customers have a claim on the business, and then eventually maybe they get some of their Bitcoin back through the bankruptcy process. And I think that, so first of all, that's how it ought to be in any case. And there's also no amount of political pressure that would say, hey, instead of people losing money from this bank run, the government is going to create more BTC and make them whole, right? So the political economy solution to fractional reserve, providing deposit insurance or providing a lender of last resort, fundamentally can't exist. And I think so that immediately stops things in its track. And it helps market participants learn their lesson, hopefully. And if they don't learn their lesson, that's fine, because they will just experience further loss of capital in the future. So the other part of it is that intelligent custodians then take a look at this reality, right? They run the game theory of, okay, well, if we go fractional reserve and we screw up, we can't get bailed out. So what should we do? Well, the profit maximizing move is to not go fractional reserve. We'll find other ways to make money. And so that's what we've seen. The companies that have been involved in the custody space that have been, let's say, legitimate and have survived, have found ways to provide services that are not fractional reserve banking. And so I think that will continue. And it really just it reinforces the title of the piece, even if the substance of it, I think that it still has a lot of truth value to it. It's just that we can actually say a lot more about it today than we could when I wrote it.
Yes, and I agree. A lot of custodians are moving towards, the smart custodians, I should say, are moving towards models that basically take this reality into consideration and use it to their advantage, because they get to show off what a great custodian they are. So I think one example is Unchained, where they actually offer effectively both types of financial services. You can do a deposit where you just have what they call a vault, and you can also do a lending where you can use Bitcoin as collateral to get your hands on dollar liquidity. And in order to do that, they, first of all of the money is always being held in a multi-sig, meaning it's all on chain. And it's held by multiple parties in many cases in order to remove the ability for different both theft and misallocation of funds by basically misappropriation by a bad actor. And with that, it's like if you set up a vault and you put it in, you can see where it is, and it's not going to be moving into a loan. And likewise, with at least the securitized loans that they do, you're sending that into an on-chain address that you can watch. And that also means that if you're going between the two, so you have a vault where you deposited money, and then you decide, I have enough money, and I'm looking at the financial conditions, and I think that it would be right to get my hands on some liquidity. If you want to then get a loan, you have to physically move the Bitcoin from the vault into effectively like its own new silo for the purposes of a lending contract, and physically meaning on chain in that situation. And then you also have companies like River, who have started to do things like add proof of reserves. And I don't know that we need to get into this here, but there's there can be limits on what we can know about reserves with such a scheme, because it's you can get the asset side but not necessarily the liabilities. But at the same time, to offer that as a service, if we have X, Y, and Z considerations of like risks and uncertainties, and you say, hey, we have this service, this won't help with Y and Z, but this will help reduce your uncertainty about X. Well, that is a step up from what otherwise would exist, and we see them offering that. And a lot of these smart custodians, they're very careful with how they handle customer funds to make sure that it retains its full reserve status. And they start doing things, like I said, like the proof of reserves, like being very, very transparent with their, the lending wallet where the security is sitting, the collateral is sitting, and make that more transparent for the customer to know where things are, to make it much more clearer for them. And that actually improves trust and gives a better experience, while once again, not mixing these things. And I think we're going to continue to see a lot of this. And the very fact that there's no FDIC on the Bitcoin side forces new levels of responsibility that banks just could get away with not caring about for a long time.
Yeah, that's right. And the other piece of the puzzle, I think, is that if you were to try to do a real fractional reserve bank with Bitcoin, where you take in Bitcoin demand deposits and then you lend out Bitcoin denominated loans, the challenge is that the borrower of those Bitcoin has to have an economic activity that clears the hurdle rate of Bitcoin. And so if you think about, okay, let's say on average, Bitcoin returns are like 40% a year, let's say, you'd have to make more than that. And that has proven to be impossible from, at scale, certainly. And in practice, what ends up happening is that they go bust, and then the scheme falls apart. And we saw that with BlockFi and Celsius this last round. And obviously, FTX, it's really funny. If we look at what SBF was thinking, he really thought of his company as a fractional reserve bank, but nobody else did. And, it would have been fine if he had been actually operating within the fiat system and had a bank license, but because he didn't, he's in prison. So it's pretty clear that any reasonable person agrees that fractional reserve banking is a criminal activity, and the government has to go out of its way to legalize it. And it's really not a free market thing at all.
Yes, and we've noticed, you'd probably remember this better than I do. I know that there are some laws on the books here in Texas dealing with wanting to ensure effectively 100% reserves. And it is funny how once you have gotten into Bitcoin, you've stepped out of the sort of fiat matrix. It is a very natural thing to understand that, you don't want a mixing of these things. You want to actually hold on to what someone gives you when they expect to be able to come get it back later. A model for this, I always think of Ferris Bueller's Day Off, where they leave the Ferrari at the garage, and a fractional reserve banker effectively thinks that the joyriding garage attendants are totally fine in what they're doing, because they got the car back at the right time. And if they hadn't gotten the car back, well, there's just the FDIC is just, we'll give them another Ferrari to give Ferris and Cameron.
That's right. And I had the honor of testifying for the full reserve and proof of reserve bill that was passed here in Texas. And when I was at a table testifying in the Texas Senate, I made the point that Bitcoin doesn't have bailouts, and so this is why we need to make sure that it's 100% reserve. Sitting to my right was the top banking regulator for the state of Texas. And if you go back and look at the video, he's not really super happy about what I'm saying. And in fact, since then, while he's in charge of implementing this requirement of 100% reserve, he's been dragging his feet, from what I've heard, is that it hasn't been implemented because they have not made it a priority to implement. So just really lots of humor there.
I think, continuing on with sort of what this means in practice, I think another interesting point is the fact that, in Bitcoin, we've always said, be your own bank. And, you're pointing out that not every individual literally wants to be their own bank. They might, still might want a bank, and it might be a family bank, it might be a community bank, it might be a regional bank, and so on and so forth. But different people have different desires for what risks they want to take on in their lives. And, but in Bitcoin, it's ultimately any quote Bitcoin bank, to simplify it, to oversimplify it in the most naive way, it's a node with accounting software on top. And anyone can fire that up. It's much easier to set up a Bitcoin bank. Anyone can theoretically do it. And I would expect if this model is good, we're going to see many competitors trying to set up different banks that deal with, those levels of risk. So maybe we'll see a lot of sort of regional Bitcoin banks, because maybe it's the case that a lot of people, they want someone who knows Central Texas, that they want to leave their Bitcoin with, just because, someone does all of their business here and they just want that sort of community feel. There might also be the JP Morgans that finally give up on their silly blockchain stuff and actually, finally deal with Bitcoin and do that at a mega scale. But ultimately, it's something that is very open in a sort of theoretical sense. And if there's a lot of these, and they're all over the world, many jurisdictions or whatever, the actual transferring and interbank settlement of it is very fast. You could even say lightning fast, because they could set up, lightning channels. They can send on chain. And each of these banks, the more that they recognize the responsibility of actually having Bitcoin, they're not going to accept, some FTX bucks as a deposit for what is supposed to go as a Bitcoin on someone's, assets. There's going to be an expectation of actually physically delivering the Bitcoin, because there's no reason that you shouldn't be able to. So with that, this solves, a major problem with how, gold sort of failed, and why fractional reserve banking was able to take as much hold as it was, is very much in part because of this interbank settlement issue. Not even just, a lot of people focus on, with gold, the actual storage. Like, you have to put it in a third party. You have to go take it and put it in a vault somewhere, because you don't necessarily want to have, once you have a certain amount of gold, it's like you don't want to have to take that around. So you have a third party for that. But I would say that, like, as much as that can have its risks, with having a counterparty, an almost even bigger problem is the fact that those banks, if they want to settle with one another, they themselves have this whole issue of being able to settle. And that is why things like central banks get argued for in the economic sense. Is it actually sort of is rational to some degree? It's like, yeah, okay, well, what if those banks now just have their own bank accounts at a central bank? And so the central bank will actually hold the gold and everyone else will just, kind of, change their numbers on a ledger. This gets rid of that and can add way more physical delivery back into the banking system, which would then force the responsibility and make it so that there's higher expectations of effectively what is a deposit versus what is a loan.
Yeah, that's right. And, to go back to the previous article, just because you don't have fractional reserve banking doesn't mean that you don't have financial intermediation. And I think that it's really a question of, I mentioned the hurdle rate of Bitcoin. Eventually we get to 100% adoption, and the value of Bitcoin's only increasing according to the growth of productivity in the economy, and also, on the side of goods and services. And then, of course, the marginal propensity to hold Bitcoin, right? The reservation demand. Eventually, one could imagine that the value of Bitcoin will stop dramatically increasing. Although, I'm not married to that theory. I also think there's a lot of good arguments for what, Saylor said of forever, but really, in the forever in the sense of, it might just keep on 10xing every 5 or 10 years or, whatever. But
seeing just how much productivity is unlocked by this level of sound money.
Yes, I agree. And the second and third order effects that we are seeing in Washington, D.C. today, it's material, to say the least. So with all that said, eventually you could imagine a world where people do go out and they go invest their Bitcoin and they put it, they send their Bitcoin to someone else, right? They take a risk. They really are lending it out or investing in equity to earn a Bitcoin denominated return. So that's one theory. The other theory is what I think of as like the great man theory of investing, which is that you don't invest to earn a return. You invest because you want to do things in the world. So you want to go to Mars, right? You're not actually thinking that you're going to outperform Bitcoin by investing all this money and going to Mars. It's very much an expenditure for other purposes, self-actualization or whatever it is, adventure, being human, right? And so I think that the utility of investing will really shine through beyond just kind of what we've gotten used to, which is the monetization of investing and the financialization of investing, where you're just trying to outperform inflation. You're not actually trying to do great things.
Right. Yeah. People chasing after glory and magnificence more so than just more returns. Especially when you have more savings, and you know that those savings alone are going to be growing with the economy and not being diluted, then you might have reason to take some proportion of your net worth and putting it towards things that aren't necessarily monetarily driven because you can afford to do so. I think that's a very important point.
Yeah.
Savings in general, just being a much more foundational part of the economy. I will have to see just how much that changes things, but I think that all finance starts with savings, and it might even be more important than we think. But the fact is that the Bitcoin network. The Bitcoin network cannot be fractionally reserved. It is only 100% reserved, and so anything else we can opt into and see how it works out for us. But we can know that Bitcoin is safe and sound, and if the Austrians are right, this will even out the business cycles and get rid of them, and also make it more certain about the future in general.
That's right.
So, well, thank you for coming on today to discuss your article. I think the next article is, I think, I would say, and actually an influential article about Bitcoin's monetary policy in a more detailed fashion. And I look forward to describing the Bitcoin central bank's perfect monetary policy and the importance of the ideas therein.
Likewise. And this is why they call me a crypto influencer, is with my content.
I mean, here we are 10 years later and still talking about this stuff.
So thanks, Michael, again for having me on as a guest. It was a pleasure to discuss these ideas. It's a small drop in the ocean in terms of what's available at the Nakamoto Institute website. It really is a website that has gathered all of the, or most of the primary source material relating to Bitcoin, its origins, its present, and its future. And so I would also encourage our audience, if you're getting value from the Nakamoto Institute and from reading it, invest in it growing, right? And I think that we have to invest in ideas that we want to see continue to grow. It is necessary for the future of Bitcoin to have people who understand its ideology, its ideas, and who want to continue to, hand that down to their children and their children's children. So find a way to get involved. It can be anything from just sending links from the Nakamoto Institute to your friends and family and coworkers, to making a substantial $1 billion donation to the Institute. Anything in between helps as well. So thank you all for listening.